You're probably wondering why cap rates are discussed all the time, and then why other people and more advanced investors, or once you have it under contract, why you start, or once you actually find a deal you really want to look at, you start looking at yield rates, or IRR, internal rate of return. Cap rates are a kind of quick analysis tool, back of the napkin, and it boils down a few things. But it does miss some of the more major components of commercial investing, like what the holding costs going forward will be, what maybe a pro forma is if it's under market rent, all sorts of different aspects to commercial real estate that could impact the value. But cap rates are a really easy, great way to do a quick analysis to see if it's something that you even want to look at. So if we look at a cap rate and it's a 3 cap, that would mean I'd make $30,000 with $1 million investment. I probably wouldn't even kind of think twice about that. But maybe that same 3 cap is under market rent, and so once I bring all the rents up to market, it's going to make $100,000 in net operating income, or NOI. Then that means that I definitely want to invest in that, because I can push the revenue, and that means that I can make a lot more money. So that 3 cap in the 2 different situations is a very different outcome on the other side. It does assess risk. So as we look at different asset classes and types, you'll see that one asset class and type will have a very low capitalization rate because the risk is lower. And it's just the same as if you go to a bank. If you have horrible credit and you haven't had a history of being able to pay your debts, and you don't have very much income, and you're an unreliable borrower, guess what? Your interest rates are going to be much higher. If you have perfect credit, you pay everything, you make way more money than you're asking to borrow, and the bank looks at you and says, well, the only risk here is that this guy dies or this gal dies at some point in the future, but then their assets will definitely still cover the debt. So very, very low risk. We can give them the best rate. Cap rates work the same way. So you get into a riskier investment. Okay, we've got Class D office space. It's got a whole bunch of asbestos and lead paint all over, like that's what they use to decorate the place. That particular asset class is going to have a much higher cap rate because nobody wants it right now. And we're seeing that in office across the nation. But then you get something else like multifamily near a downtown center, and there's 300 units, so you've got 300 different points of income. It's a little bit more to manage, but the management and everything's already paid for. So then the NOI can be high, but then your cap rate can be really low, and they might pay a 5% capitalization rate on something like that because of the stability of that asset. When that happens, and as you see rents increased and different things like that, we see really low cap rates on those multifamilies because of that stability and kind of where we are in the market cycle. So that's kind of why you might see differences in cap rates between different asset classes, and just some more food for thought on when you're investing. Make sure you're not paying 5% capitalization rate for something that usually trades at a 10 cap.